So you don't need any credit card information. You can just go to PowerOp.com, put in your name and email address, and you can have a 14-day free trial. If you just started your trial, I encourage you to take advantage of the 4 steps that are listed here. As far as we go with the quick start guide, there are a variety of free flash tutorials to get you familiar with the site. We have a wealth of information in the archived webinars for tools, strategies, management techniques, options concepts, and of course the recordings of our Friday session. That's all in the webinars page there. We'll reference that later. And remember, trial members and subscribers can schedule a coaching session at any time here at Power Options. It's a 35, 45-minute phone conversation with myself or Ernie. We will walk you through the tools on the site and answer any questions that you have. A basic question, a general question I should say, came in from Doug. Doug wants to know, is this going to be recorded? Yes. I just started recording when I switched over from the main description and went to Power Options, Doug. And of course, when we go into the free webinars page, this is a public page. You do not need to be logged into your trial account to access it. I'll send everyone the link. It's just powerop.com/webinars.asp. There we go. All right, and all of our Friday discussions, so from December 31st, your final questions from 2018 and our favorite topics from 2018, they're all posted here in the requested topics section. That'll show up probably on Saturday or maybe a little bit after, okay? All right. Okay, I'm looking at a question from Sam right now. Some of the questions came in. Remember, you can send those questions at any time using the question pod. All right. What in the world? Okay, so first let me take this question, Sam, before I completely missed what you were looking at earlier. My apologies. Well, let's take a look here. So we're talking about a far out position. I have a GE call debit spread. 7 to 11. So we're talking about a bull call debit spread where we may have sold an out of the money call and bought an at or slightly in the money call on GE. Okay, so standard bull call debit spreads at 822, and we're out to March. So per our discussion last week, a bull call debit spread is sort of a parity to a bull put. But you want to do the bull puts out of the money where they have a high probability. Maybe selling the 7 and buying the 5. Selling the 6 and buying the 4. You don't want to sell an in-the-money bull put even if you're really bullish. I wouldn't want to sell an 11 put with the stock trading at 820 and buy a 9 or buy an 8 because I run the risk of early assignment on the 11 strike because it's in the money, and that might change the dynamic of the position per your expectations. But when you do a bull call, if I bought a 7 and sold an 11, and right now I get this at about 160, it cost me 160 to buy the 70 call for March. I'm going to hedge that by about 10 cents for selling the 11 call. Naturally, to do this, to make it profitable, I'd probably have to do multiple contracts. And I don't need to know the numbers, Sam. But, you know, you'd have to do multiple contracts. Let's just use one for example. Okay, 7 to 11 bull call debit spread, sorry folks, has a low cost basis of 150. It's speculative because to make the maximum profit that's shown, GE would need to be trading above $11 per share in the next few months. Now, this is not to say that this position won't be profitable at any time between now and then if the stock's below 11. But to receive this maximum profit, this low-cost debit, and to get the $4 back. All right, so what happens in a debit spread? We purchased a 7-strike call that's slightly in the money. We sold, meaning we have an obligation to deliver shares of GE at 11 for a small premium. So it's like a covered call, buying the stock and selling the out-of-the-money 11 call. We don't own the stock. We own the right to buy stock at 7, and we paid a premium of about 157 or so. Or is it 257? My apologies. Let's just take a look. 160. Okay, so we bought that for 160-ish. Okay, so we have the right to buy shares of stock at 7 for a premium of 160, and we sold the right to deliver them at 11. If the stock does go up by 11, you hold it all the way to March and you do nothing, your broker may essentially buy shares of stock for you at $7, sell them at 11. You get a $4 profit, but we spent $1.50, $1.60 in to the position. $1.50, I'm sorry, that's the maximum risk. So we can get $2.50 back on an investment. But unlike a bull put credit spread where I'd want to be out of the money for a higher probability of the positions expiring worthless, looking at maybe an 8, 9, or 10% leveraged return, but having a 75% probability that the stock would stay above my strike price at expiration, here we maybe only have a 15% probability that the stock will be trading above 11 even though we're out to March expiration. As Sam comments, it's like a 50-50 trade where we have a 1-to-2 risk-reward ratio. Okay, so if the stock does go up above 11, he could make 250 for a cost of 150. It's about a 50-50 shot. His break even, of course, is only 850, and he's getting close to that as well. Okay, so this was the question here, and this was the comment here that it moved up a little bit. We saw some movement here, and let's take a look at what we saw in the chart. So I'm just going to go to big charts. We know it was down further, all right? So we dropped down almost about $5, $6 per share, probably about in the 7 range, and we had it pop up here in the last couple weeks, last week and a half really, to move back above $8 per share. And we're processing, you know, Sam is probably thinking that it's going to revert back to the norm here, the previous low that broke through with the help of the market for November and for December's volatility, that in 2 to 3 months the market comes down. We might see G just gradually move back up to 11, and he'll have that high profit on a number of contracts. It's possible, but we have to wait and see. Now, how can you make money on this spread? Well, you've already got one short obligation, of course, and you only received a small premium for it, about 10 cents or so. Now, in the next couple days, let's say Monday it goes up another 10 cents, Tuesday it goes up another 15 cents, maybe a hiccup on Wednesday, and then Thursday it goes up 40 cents. So we're basically at around $8.90. Okay, and that's very speculative. I'm not saying that's going to happen, but let's say that it does trigger and it moves back up. It gains 80 cents or so. Your max profit we saw was 250, 166%. Because there's so much time value remaining in the options, as it starts to move back up, you're going to gain more on the 7 strike call, which has a positive delta naturally, then you're going to start losing on the short option, which maybe only has a delta of 0.2 that's working against you. So with the stock movement here, we'd expect to see a gain of maybe 52 cents on our long option, which we own, and maybe only another 10-cent gain in the short option, which is a negative to us. So we're losing that 10 cents, 9 cents, 10 cents. So we'd still be positive around $44 or so. 1/6 of the maximum profit. Okay, but just like a calendar spread and just like a covered call, as the stock moves up, we're going to be able to see more profit on the position. Now, time decay also works in your favor here. Yes, you're going to lose on the long, which started out in the money, but the short is also going to decay as well. Let me go back to $8.90. And even if it takes a month to move up a little bit more here as we get closer to expiration, let's go to 211, halfway between essentially, or close to it, yeah, 111, but halfway between, getting close to that end of March expiration, you still have a profit that's about the same, okay, because the time value is affecting both, and you're sort of, I know you hate me to use this term, Sam, I hate to use this term, you're sort of straddling the stock price with your bull call debit. So as the stock moves up and down, the in-the-money call 1 or 2 strikes in the money and the 1 or 2 strikes out of the money call, depending on how you look at it. But they're going to lose a similar amount of time value, even though one's in the money and one's out of the money, as long as there's no more fluctuation in volatility or anything along those lines. If GE starts to settle and starts to move up as you expect, another thing that may work in your favor but could also work against you, let's go back to 124. Let's say the stock's at 890. But let's say it goes up to 9, okay? So it gains another 80 cents or so, about 10% in the next 20 days. Well, if the market's stable, things calm down, shutdown ends, things look better on the horizon, we might also see these numbers start to drop, the volatility of the options. Why is that important? Well, let's cut them in half. We'll cut it down to 0.32 for the in-the-money 7, the out-of-the-money 11, and the stock moves up to 9, 20 days into the trade. See, now we start to see that we're creeping up. Now, we did get a little bit more gain because we put in $9 instead of $8.90, but at the same time, if volatility drops, that means we're going to lose time value here. We're also going to lose time value here. And as we're creeping up here to 9, we're in this 40 cent, 50 cent profit range. Again, 1/5, 1/6 of your expected maximum profit, because you don't start to get to these values until you get within the last 20 days or so to expiration, with or without implied volatility fluctuation. Now, I don't know GE off the top of my head. Well, we all know GE, of course. But I mean, I don't know their specifics and what's going on. So let's take a look at something else here. Okay, earnings are coming out before market on January 31st. Depending on where the stock is, naturally you might want to prepare for that as you get closer, meaning a week before, 2 weeks before, maybe a few days before. Depending on how the situation is looking, you may consider buying an additional put. So maybe turning it into a strangle with, say, your 7 call you already own, but owning a shorter term 8 or maybe 9 strike put just in case there's a negative flux at that time. I don't know if it would happen. I don't know if GE could put up enough numbers where we'd see this go back to 12 or 13 or 14. But if I had another put here around earnings, that's going to put me in a different position. It's not going to give me sort of that calendar strangle with a capped upside. It might act, depending on what you have to pay for the put, it might actually do this. Okay, so you might actually have a debit spread that continues to lose up to a certain point because of the cost of the new put and the capped upside from the short call. It's useful if you're expecting a down movement and the down movement occurs, but if I'm in this type of bull call debit spread going into earnings and I'm expecting a down movement, I may just want to close out of the spread if it already has a profit rather than try to force to turn it to a profitable position and risk the upside if I'm wrong. Let's just take a look. Let's say as we got closer to the 31st, I buy a February 8, let's just call it a 9 strike put, but let's say the stock's a little higher. So let's say we can get this for 70 cents. Volatility would be increasing at this time as these options are going to be most affected. Anything after that is going to be most affected. Anything after the 31st is going to be most affected by the earnings. See, this gives us kind of, this isn't too bad. But again, you've cut down sort of on the profit because of the cost of the put. We expect that. You have to pay for that. It's still a reasonable gain on your total cost into the position. We've increased the $1.50 debit by 70. We've lowered that by 70. And of course, it shows us a reasonable maximum risk here. Now, of course, that's also based on after the earnings, the volatility might drop again. Would that affect your trade after the 31st? Well, the long options might lose more value. So again, let's say we stay right at 9. The worst possible scenario for this spread we just built, a bull call debit with a kind of expensive but cheap put that's a little bit closer in, but will cover us through the earnings on the 31st. But let's say it stays at 9. after the earnings, so on February 1st, February 4th, and let's say the volatility drops back down after the earnings to 0.35 from where it is now. See, that's the worst case scenario, but it's not bad monetarily based on the expected prices of the options. Your 11 call is almost worth nothing now that you sold. The put would drop, lose a lot of value, and you'd gain some back on the call. So you're still at a loss in this scenario here, but it's not bad at all. That's only through earnings, because if you add the put now and the stock moves up maybe as you were expecting, Sam, you're going to take away from the potential gains in just the bull call debit spread, and if it does move up well, meaning your speculations, you could have half of the gain possibly if the stock was at 950, 920, somewhere in that range as well. Okay, so, oh yeah, and you could do a March instead of February. I just did the February to show a cheaper cost on the position to go through earnings. Okay, that's all I was looking at there. Okay, so your plan is to close it before earnings. Sure. Okay, so I was just mentioning that, or you might do a different trade before earnings also, Sam. And you go on to talk about your SPY bull spread you turned into a credit and so forth. We covered this a little bit last week, but that's fine. And we want to cover it again. Jonathan? No, John. This is John. I'm sorry. This is just John. John asks, you said that the bull put was a parity to a bull call. How are they parities? Okay, we covered this a little while ago, last week. One of the topics that comes up regularly, and that's perfectly fine. We'll look at it again. Not going to use GE as an example. Let's just take Starbucks. It's something I'm in a married put in, so I know how the stock's been performing. It's been down, it's been up. Whatever it lost yesterday, it almost gained back today. It's kind of, okay, still about 40 cents short of where it lost yesterday to what it gained today. John, let's say I'm bullish on Starbucks. And I'm going to do this first. Let me add bull put credit to my available strategy. So I didn't have it from our last webinar. I had bear spreads up. Last discussion we had some iron condors. I'm going to take out one of my strategies and we're going to put in bull put credit spread. So here's all the strategies that we have available on PowerOptions. I'm just going to add bull put in. Let's save that. All right. So I'm going to go to search by symbol. I'm going to take standard expiration, John. $15 days out. I'm just going to go more results. I may do this a different way depending on what I see. Yeah, I'm going to do this a different way. It's just easier. Okay, so instead of this, I'm going to use the spread chain tool. And what I want to look for is I can look for credit spreads, have at least 2 strike difference on Starbucks. I want a minimum return 15 cents, probably closer to 20, but I'm going to leave it at 15. I want to be a reasonable range out of the money, 1 or 2 strikes or more, probably 2 strikes or more. Most importantly, I want a probability above 75%. We're still making a reasonable return of, let's say, 8%. So my bull put credit spread, I'm going to sell an out of the money put. I'm going to buy a deeper out of the money put for a credit. And as long as the stock stays where it is or moves higher, both puts expire worthless and I keep the net credit. The reason I wanted to use this tool here is because I didn't want to mess around with all the 0.5, 1.5, 50-cent spreads, okay? Like a 1 or 2 point spread, and there's a reason why I prefer a 2-point spread. Here's a good one if I get midpoint. With the stock trading at 63.57, the January standard oh no, that's January 25th. That's why it looks so good. I want January 18th, standard expiration. Still going to get a good trade though. All right, perfect. So the 61.59 bull put spread. Selling the 61 with the stock at 63.57, not a lot of room. Buying the 59 gives me a 23-cent net credit on a 2-point spread. which works out to be a 13% return, and we have a 78.8% theoretical probability that the stock will be trading above 61, okay, in the next 14 days. Here's just more of a simple graphical view of the position. But remember, anytime you're doing a spread, we want to remember what our obligations are. I've sold a put at 61, which means I may end up, as a potential outcome of the spread, owning shares of stock at 61. If the stock falls below 61, I get put the stock. The 59 put expires worthless, okay? We had managed before that. It's always important to remember that even if you're a spread, the outcome of this bull put spread is you may end up owning stock at that short put strike price without management. We get a decent net credit of 23 cents, 12.7, 13% return. If the stock stays above that strike of 61, both puts expire worthless. Okay? Now, I could do a bull call debit, maybe, with the same exact strikes, which would be in the money for the calls instead of out of the money, and it would cost me a debit. But I'll have the same probability, but I might have a higher return. And to see that on this tool, I'm going to click on Put Credit and Call Debit Parity. I'll put this back down to 15. The numbers change just because I was looking at this differently, and I wanted 70 here, so let's go ahead and do that. Okay, well, 75. Let's make it cleaner. There we go. Okay, so in SBUX, there's my same two bull puts we were just looking at. The 59.61 with a 23-cent net credit and a 13% return. And John, what I could also do, instead of doing the bull put and getting a credit of 23 cents, which would put me at a maximum risk of 2 points on the spread minus 23, which would be 177, which is where the 13% is coming from. We have a 78% probability. I could do the same trade by a parity trade by selling the same 61 call for 303 at midpoint, buying a deeper in the money 59 call, same strike, 59.61 for 478. This is a debit at midpoint price of 175. And at expiration, if the stock is above 61, I essentially buy shares of stock at 59. To deliver at 61, I get $2 back, so I'm making 25 cents if it works out as I expect, the same 78% probability that the stock would be above 61. So I'm getting a 14.3, a little bit more bang for the buck. If what? If I get filled at midpoint prices for the two calls, and the stock does what I want and stays above $61 per share. Okay, that's the parity view. They have the exact same risk-reward profile, exact same probability when done at the right strikes. Now, Sam was a bull call debit spread, like we just saw, but he did it out of the money, which I won't do with a credit spread because that means my short put will be in the money, and I run the risk of being assigned and having to buy shares of stock at someone else's whim. Of course, if the stock falls, SBUX fell below 61, I'd be in that same position. Well, let's see if we can do this here. Let me move this over here. Here, the system didn't like that at all, did it? Okay, let's go back down here. Sorry about that. Okay, there we go. Okay, so here's my bull call debit spread. Midpoint of 478 for the long, 303 for the short, total debit of 175, knowing I'd get $2 back or 25-cent profit off of my investment of 175. So there's the bull call debit spread. Credit spread, same graph. 23 cents instead of 25, risk of 178 instead of 175 roughly, 12.7% return if the stock stays above 61. Those are the parity trades when they're the same strikes and same expirations. What's the catch? Even though this debit spread gives me more bang for the buck if I get filled at midpoint prices, I still have to remember that the debit spread is reliant on paying another 1 or 2 commissions to actively close or let be assigned the in-the-money calls at expiration. If I left it open and did nothing, John, and the stock did what I want, to get the max profit, my broker may have to exercise the long to essentially buy shares of stock from me at 59 to deliver them at the obligation I have on that short call at 61. Depending on your broker, they might charge that as 2 stock commissions. Okay? You could go in beforehand and unwind this trade, liquidate the spread, and they might only count that as a spread commission, which might be lower than 2 stock commissions depending on who you're trading with. Okay? Whereas in our bull put, if things work out as we expect and the stock stays above 61, both puts expire worthless, I don't have to do anything. You might get a fee for paperwork for filing for expired options or options that expire. It depends on your broker again. But that's the idea. Okay? Why is that important? Although this is a 1.3% higher return, 14.3 versus 13% for the parity trade bull call spread. If you're only doing 2 or 3 contracts, remember this is only 2 to 3 cents higher, which is the 1.3% on 23 cents. Okay? If you're only doing 2 contracts, you're only getting 4 extra cents, and your commissions are $9.95 for a stock, and your broker's going to charge you 2 stock commissions. This is not the better trade because you have to actively close it somehow to get the maximum profit. Okay? So naturally, as Sam says, you'd be doing 20, you'd be doing 10, you'd be doing 50. You'd be doing more of a number of contracts where it makes sense, but you have to remember the extra commissions to unwind the debit spread. If you're looking at a difference of only 1 or 2 cents, even though it's 1.3% higher, at the lower number of contracts, 8 contracts, 10 contracts, 5, well, you have to make sure that the extra commissions are worth it for that extra increased premium of 1.3%, that extra return. But that's the parity. It gives us the same risk-reward profile. One is done at a debit, one's done at a credit. But I always check, if I'm opening a bull put, I always check the bull call debit spread. So you look at the other one here with the 83.2% probability, with the 60.5, 58.5 2-point spread. So net credit of 18 cents, just under 10% return. But if I get filled at midpoint with a debit of 178, that would be a maximum profit on the 2-point spread of 22 cents versus 178. I'm in this range here at 12.4%. I would seriously consider trying to get into this debit spread at midpoint as opposed to the bull put credit spread, because 4 cents over 18, it's an additional 3% return. That's more bang for my buck. But if I just have the money to put up 5 commissions, just have the money to put up 5 contracts into that spread, I've got to take account the extra commissions and how much will that eat into this extra 4 cents premium I'm getting. Okay. All right, so that's the tool we use. It's the Spread Chain tool. You can find it under any of the vertical spreads, bear call credit or bull put credit on PowerOptions, the Spread Chain tool where you can see the parity view. It's also one of our signature tools as well. You can access it there with the long option finder, our stock repair tool, and the insurance tool as well. But anytime you're planning on a bull put, it's always a good idea to compare it to the debit spread. If your plan is to do the out-of-the-money spread, speculating on a market movement like Sam showed us with GE, the out-of-the-money 11 call and slightly in-the-money 7, to get sort of that 1-to-1 risk-reward ratio, don't do that with a bull put credit spread, because that means you're selling a put that's in the money. And you can be assigned. And if it's between the strike prices on the bull put, let me go back. Let's put this in again. Now I'm just going to show this as the bull put that we were looking at very quickly. back to square one for our GE spread. There we go. But on the bull put now, this is in the money. So if the stock is in this range and someone decides they want to exercise you, they want you to buy their shares of stock, they exercise their long put, you end up buying shares of GE at 11. Now that's okay. You've got a debit of 149 as well. Factor that in, and you've got this 7 call that's gaining on it. No, I'm sorry, that would be a 7. If this was the bull put, I'm sorry. You get assigned early because this is in the money on the put spread. Even though I'm showing a call spread, and the put spread might have given us a credit of maybe $1 or so. Anyway, we get assigned early. We now own the stock in a long put. So now we sort of have a little married put out to March, which might not be that bad. You're not near the maximum loss yet. You could turn around and sell to close the stock at 823, at 850, at 9, whatever the market is trading at, and you still have the long call there, long put, excuse me. Then if it continues down, that might actually still make a profit, okay? But that's why I would never do this. I would never straddle or go fence in the stock price with a credit spread because the short put or the short call is going to be in the money, and that's not what I want. We have seen it happen in the past where in that situation, someone gets exercised early on the put, and you say, oh, well, you tell a broker, oh, you should have exercised long to deliver the short. No. If the market's trading at 9, you get put stock at 11, you want to try to sell to close the shares of stock at 9. You would never want your broker to exercise the long put at 7 to sell your shares of stock when you can get 9 on the market. If you didn't want to own the stock as soon as you're told that you were put the stock because you were exercised early, you want to go into the market and sell to close that position or redo your bull put spread based on your goals for the position and what you want to achieve going forward. But I would never do that with a bull put. I'd always want it down here. But when I do a bull put or consider a bull put on a stock that has the probability and the return that I want and the spread difference I want, then I want to compare it to the bull call debit with the same strikes to see if I could get more bang for the buck if I'm filled at midpoint, and that's what I use the spread chain for, John, as well. Okay. All right, Sam had a high return, he says, on puts on StarBucks before today, and right now you've got a call at 61. Yeah, so you have the right to own the shares at 61. So that was different than what we were showing. That was our cap on the StarBucks was at 61. Okay, and then you had some movement on the Apple positions as well. Oh, okay, so I'm sorry, Sam says that he had short puts on StarBucks that he profited with, and then he rolled those down into long calls. Okay, so he's making a subtle bullish play here. And yeah, StarBucks was fun for me in the married put. I was going to do an adjustment yesterday, and then I was glad I didn't because it rebounded today. And I had a feeling it was going to. I just didn't think it was going to be equal to 1-to-1 almost. Just shy of 1-to-1, but a lot of stocks were like that today. So it's at 63.57 right now. And let's go to a 5-day chart. Oh. Yeah, so there's the drop there. I'm sorry, we had on, yeah, it's almost right at square one, isn't it? So on Thursday there at the open, we had that drop. It dropped from about 63.70, 63.80. Did close it close to 64.20. We had that sudden drop there down to 62. Actually went as low as 61.50. Went a little bit lower, and then today, almost right back to where it was before Thursday. Petered off a little bit, but that's what I was saying as far as that 50 to 60 cents we just missed, 40, 50, 60 cents we just missed there. So Sam, I guess, is saying he caught it at the right time. You had some puts here. I think that you got into, you sold after the decline, and then when it gapped up today, you closed out your short puts for a lower price, and then started to buy the calls on those, and you're at the 61 strike. You were at the 61 strike, and that's where you have right now. And Good volume right at the end of the day there. That's pretty good. Good volume there at the end of the day. I missed that part. So yeah, I have adjusted this once already. That was talked about in the webinar today at 12 noon, where I lowered the strike down to the 65 strike in the married put way back last year. Actually, I did this. December 20th, I believe it was. I rolled the position down from the 70 to the 65 put and took in a credit of 656 on my stock to lower my cost basis. And then on the 31st, it's not shown here, but on the 31st, it was almost right back. Oh, it is, isn't it? Yeah, on the 31st, we were almost right back to 65. Yes, so we were almost right back to, yeah, it's throwing me off. I'm trying to remember. Tuesday, the market was closed. Tuesday was New Year's Day. The market was closed. Sorry, folks. So Monday, yes, it almost got back to here. So I got into the stock at 67.22 and bought the 70 put for January at 790. And the stock fell as low as 60.56. So it was down $6 and about 60 cents. It was $6.66 actually at the low point. 9.9%, excuse me. And that's when a little bit after that is when I made the adjustment and moved the 70 put down to the 65 for April. So I got a credit, about 565, which lowered this total cost basis from 75.12 to $69. When the stock came back up to here, my liquidation value was about 68.70 or so. So I was still losing 70 cents on the trade, but keep in mind at 64, that's still $3 or so below, 5% below where I bought it, and I was, because of that one management, I was almost just back to break even. And then this happened, but then this came back. So I just left it alone there. Could have sold the 65 call, but I don't want to cap the gain on it right now because it's not profitable to do that. Okay, so I just wanted to run through that real quick. That's what Sam was talking about with the movements. He did a couple of day swings in SBUX. I was looking for an opportunity to roll it, and when it gapped down the other day, when it gapped down Thursday morning, I didn't want to touch the trade until it settled down. Was looking for something today, and it opened up almost right back to where it had closed the day before, pulled back, and then went back up again to near that high it recently had, or the same price it had before yesterday's news of Apple and other securities as well, maybe giving guidance. And then, of course, we saw the huge Bristol-Myers Squibb deal, right? I believe it was $74 billion. The BMY is buying the other big security, the other big biotech there for $74 billion potentially. I didn't see how that played out today. Further, what news came out of that, but it gave a big jump to one and non-movement for the other as well. Okay, let's see what else we've got here. 5:15 p.m. Eastern time. We talked about Sam. Sam also had some SPY bull puts that worked well for him. He was trading for this week's expiration. Sam, I don't know if you're opening it. Do you have open any Monday or Wednesday SPYs, or you're just doing the Fridays? I don't have, other than married puts, I don't have anything open for this weekend. I closed out a couple of my positions, spread-wise, diagonal spreads today, as well as other positions, because I'm just not sure with that move down yesterday and then the pop back up today. It looks positive, but I took some profits off the table, not great profits, but not losses, because I don't know what's going to happen Monday. I'm going to reassess and open some new positions on Monday. Maybe some diagonals, maybe some, diagonal calendar spreads, excuse me, maybe some credit spreads, likely one or two married puts also, and maybe some straddles. I haven't decided. Triangles more likely than straddles. Question comes in from Jim. And Jim says, we talked about VIX calls a little last week, and VIX calls for hedge for the portfolio. Do you think now is the time to buy VIX calls? Jim, again, I touched on it on the webinar. And to tell you the truth, I think this is personally for me, the way that I use them, this is too high for me. I want to see it come back down. I'm not saying it's going to, but I'd like to see it come back down to the $16 range, $15 range, maybe lower, before I buy more calls on the VIX that are 1 or 2 months out in time. it's probably not that bad. It's probably not that expensive if you think there's going to be a continuation of market fluctuations. My apologies. But I would probably go out. Would I go out to March right now? I think that's too far. Yeah, that's way too far. Well, it's not really, depending on what can happen. Let me look at February 13th. It's 40 days out. That's pretty good. With the VIX at 2138 right now, 26 is not bad. That's what I kind of use for a target. It's the dollar premium. Okay? And I want that to represent about 4 or 5% of my total portfolio. But that's at 26. Has the VIX been above 26 recently? Yes. Did it go far above that? Yes. Does it have staying power above that? No. That's about the peak. This is February 5th through 9th. We went up as high as about 37. Really, it was 36.40, I think, in that case. But then it was right back down to 30 and then below 26 the next day. That was a 5-6 day period. Okay? And it barely went above that the last 2 times there was a spike. That's why I'm saying I'd like to see it come down more. I'd like to see it in the 16-15 and buy a 20 or 21 40 days out, 30 days out. So if it spikes up this direction, then I might get it up to 26 and might get a profit on that at that point. Okay? So that's sort of what I'm looking at there. I worry about it that even if it does go back up, it'll just come back down unless there's an event that really pushes it. There's always an event that really pushes it, but I'm waiting for it to drop down. Does that mean I'm buying puts right now? No. I'm not buying puts on the VIX. They're a little bit more expensive. And look, if I buy a 19 put for $1 out 40 days and the VIX creeps back, if it goes down to 18, this is not going to be worth $1. And this might not be worth $2. The volatility of the VIX is going to decline rapidly. This might only be 40 cents. Remember, it doesn't work intrinsically like regular options. Right? It's based on, the projection of the volatility. It's not based on a straight underlying. So even if in the next few days the VIX drops back down below 18 or below 17, this 19 strike put right now at $1 might not give me a profit, or it might be at break even. Okay. There are, of course, other securities you could look at. You could just buy 1 or 2 shares of, let's say, VXX, which is trading at $40 per share. Sam always talks about how he uses, it's $43.94, excuse me. Sam uses UVXY, but he's out at 80. Okay. And UVXY, of course, now is trading, I think, back down to 70 or so. It's another volatility ETF. Okay, it's 74. Yeah, it's down to 74. It's the ultra short-term ETF, UVXY. And it declined today, of course, with the VIX. And it's a shorter-term range, but his... oh, you got in at 64, got out at 80, of course. That was the good move. $16 on that position. But we wait for the buy, almost like we were talking about with the calls, excuse me, Jim, even though I'm using it as a market hedge, I wait to see the buy price. And just like Sam said, 73, 74 right now is likely not his buy price for UVXY as a market hedge with a couple hundred shares. 21 is not where I'm looking to get into the VIX calls right now. I'm out of all of my VIX calls, I'll be honest with you. We talked last week, I was still holding a couple. I did get rid of some of them on Thursday just to take the profit off before it declined further. And it wasn't nearly as high as a profit as I had up here when it was at around 31, 32. I didn't call the exact top, but I got in at sort of the plateau bubble here at 30, 45, I think it was, and closed the others when it was at 27. The other day. I didn't hold on for it for that long because it's just been going down. So I might as well get rid of those calls now. And, the other things were going back to normal. These are all bullish positions. Ollie, Omex, Penn, I'm out of them, sorry, but StarBucks, Goose as well. Those are all bullish plays. And so they're doing what I want today while the VIX is dropping. So I wanted to get out of what was giving back to the market. I'm going to stay into these, of course, and then look for a point on the VIX calls. Again, the 26 strike does have the dollar premium I'd look for. And I could buy the $2 premiums maybe at 22 or 23, for example, I think it was, and just buy half the number of contracts, sure. But if it continues to go down, I'm going to watch that $2 on that 22 or 23 strike deteriorate rapidly. I'd have the same money, and I'd have, let's say, 4 or 5 contracts in at 22 or 23 for the calls. Let's just take a look there. Where were we? It was about, oh, no, yeah. Yeah, so the 22 strike. Now, I might buy, let's say, 4 contracts here and have the same monetary risk. But if it starts to fall, this $1.85 is going to collapse drastically, quickly, especially if the implied volatility of the options on the VIX index, the implied volatility of the options on the volatility index drop quickly. You're going to see this premium just get swallowed up. If it does go back to 18 or 17, that's just going to evaporate fast. That's not what I want. I'd rather wait for it to do that, which I think it's going to go down to maybe 19 or so or 18. I don't know when. Not saying Monday. I'm not saying Tuesday. But maybe by sometime next week or the week after, we'll be back in that range, a little settling and calming of the nerves, hopefully, before the next headline comes out about someone doing something. And the VIX spikes again. But that's where I'd want to go. And then I'm going to look at the 20, maybe the 21 strike to get in at maybe $1 or a little bit less, rather than get in now, see it turn to a 50, 60, 70% loss on my market hedge, which is okay, as it's only a small portion of my portfolio, then hoping that by February 13th there's some other spike where it goes back up to 26 and I've got the profit back. Okay, so that's as far as the market hedge on the side there that I use to counter some losses in uncertain markets I might take on my bull puts, which again I don't have right now, they're all closed. My diagonals, which are all closed, but looking to open new positions on Monday, depending what we see the market do. And if it hits that mark, then I'll look to get back into VIX calls to hedge that portion. But right now, since I don't have those spreads open, I don't feel a push to buy the VIX calls, Jim, at this point. But once I get those open, I'll be looking for a time to get in as well. Okay. All right, well, at 5:25 p.m. Eastern Time, I don't see any other questions that came in. There's one more comment from Sam. He had an Apple Condor 130, 135 puts and 150, 155 that closed today with Apple at 148. So that's great. And what did Apple? I didn't actually see what they did today. I know we all know they dropped that 9% yesterday. Did they gain most of that back? They gained half, little less than half. Okay, that's not too bad at all. So this, yeah. 142. You're still looking good even if it stayed where it was, which we probably knew it wouldn't, that it would have a rebound there, but it was at 142 there. You're still well out of the money for one day, hopefully, for that 135, 130 spread on the bull put side for that iron condor. So that's very, very good. Very good. You weren't even threatened yesterday with a 9% drop. A little bit threatened, but not a lot. And then, of course, their earnings are coming up, as we talked about, right around GE's time on the 29th after the market. GE, I think we saw, was the 31st before the market. So we're getting back into that, getting back into earnings season here. So just always a reminder to make sure with your spread positions or your covered calls, make sure you know when your underlyings pay earnings. If you're in standard securities, and you might want to adjust your positions, even if you're in a covered call, accordingly by adding a put to make a collar or adding another position to maybe profit in both ways, maybe take off the covered call and do a ratio protection on it so you can profit in both directions with the stock delta and the put ones as well. We know that some Apple, I know I showed you this coming up on the 29th, they already said they're going to be missing, into what range they're going to be missing. And the exiting, the Sam comments also that the straddles around earnings and exiting the straddles around earnings is going to be pretty interesting. It's going to be interesting to see what happens, and it's going to be interesting to see how fast the market reacts to these events coming up, so we can get another gauge of where we feel and where everyone else feels the market is going as well. Whoops, sorry folks. All right, there we go. So I just want to remind everyone that today's material are my thoughts on your questions, your comments. designed for educational purposes on options trading, avoiding risk, hedging your portfolio, and trade management. Any stocks or options discussed today should not be taken as trading suggestions. I am not in the GE position that Sam said he was in. I am not in a bull put credit spread on Starbucks. I'm in a protected married put position that's posted in the Fusion portfolio at Radioactive Trading. Options do involve risk, may not be suitable for all investors, of course, but I'm not making any trade recommendations. We're just analyzing the market, analyzing positions, getting some good options talk in and strategy talk as well. All right, now I just want to remind everyone those radioactive trading techniques I mentioned. We still extended the end of year special for the blueprint through the end of Sunday, January 6th. You still have the opportunity to pick up the blueprint, the full discussion on setting up the limited risk trade, the 12 different income methods we use off of that to potentially bulletproof the trade where we have no risk going forward. No risk through an earnings season, very useful as well. But you can just go to radioactivetrading.com, click on the products tab, and if you pick up your blueprint before January 6th at midnight, you'll get the 7 special bonuses for the end of year promotion as well, including a money back guarantee, free shipping, extended access to power options, and the Fusion service at Radioactive Trading as well. Okay. Now, if you wanted to take advantage of some of the tools we showed today, looking at the spread chain tool to compare parity, using the custom spread tool or the option chain, of course the portfolio tools to track your positions, remember you can get a 14-day free trial at any time. Just go to PowerOp.com, put in your name and email address, click Start My Trial. No credit card information or anything is needed. You can start your 14 days at any time. You have full access to the tools on the site and full access to myself and Ernie as well. No credit card needed. After that, the monthly subscription at PowerOptions starts at $40 per month. That's only for end-of-day data. We do offer a 20-minute delayed service for only $60 per month. It's a really good deal. We have a full historical tools for backtesting purposes and looking at historical options chains that goes back to April of 2006. That's only $40 more than the delayed service. You can have access to all of the history plus the delayed data for only $100 per month, and we do offer a real-time service, and then everything packaged together is the premium service. The subscriptions start at just $40 per month. There's other free education on the blog, of course. Earlier we mentioned you can go to our public webinars page at any time, powerop.com/webinars.asp, to view all of our archived presentations. A lot of those are going to be changing within the next 3 months. As we redo some of the important presentations, show some new structures as well, and go through to sort of enhance and update our webinars pages. Remember, everything is also available on YouTube. You just go to YouTube and look for Power Options. Well, I thank you for your time, ladies and gentlemen. I hope you had a good and profitable first week of 2019 and a good week aside from everything options of 2019. Happy New Year once again. If you do think of any other questions anytime, send me an email to support@powerop.com. You can also reach me at support@radioactivetrading.com. And remember, you can also call us during market hours at 302-992-7971. And if you're currently on your trial or you're a current subscriber, remember you can schedule a coaching session at any time. Sam, thanks a lot. Jim, thank you for your questions. John, thank you for your questions. Ladies and gentlemen, thank you for joining me. I'll let you know when this presentation has been posted. As Sam says, let's make 2019 a profitable year. Let you know when the webinar archive is posted, We'll let you know of other webinars coming up in the near future. Take care, everyone. Have a fantastic weekend. Good night.